Alrighty, Business 163, Personal Finance. We are continuing in our series on taxation. And now we're really going to dive into, well, what's up with our personal income taxes? How do we figure out how our taxes are calculated and how much we owe? And as you can see from the title slide, we ask the question, well, what's this whole thing about progressive and regressive taxes, and what does that mean for us when we're calculating our tax bill? So let's climb into this. Those are terms, progressive and regressive taxes, you may not have heard before. So let's talk about this. Well, one of the first questions that people continue to ask is, how does taxes affect different income groups? There are obviously people who make a fair amount of money, and then there are people who don't make so much money. And the general feeling for most of us here in the United States is, well, you know, people should pay their fair share. We just looked in the last video at how our tax dollars are spent, right, to support things like Social Security and provide for schools and for Medicare and all those kinds of good things, right? But people should pay their fair share. And we have to acknowledge, because there's a great difference between one household and another and how much money they make, that quite frankly, depending on your situation, a dollar paid in taxes might hurt you more than somebody else, or vice versa. For example, let's say at the end of the year, one person, both people, two people owe $8,000 in taxes each. Well, imagine this for a second. If one person earns $80,000 a year and they owe $8,000 in taxes at the end of that year, well, that's substantially different than if a person only earns half that, $40,000 a year, and yet they owe $8,000 in taxes. You can see right there, wait a minute, that doesn't seem, well, fair, because it's certainly going to hurt person B an awful lot more than person A. Well, that's one way that we can think about what's fair in terms of a tax system. And this brings us to the whole topic of progressive versus regressive taxes. So let's explain what that means. You can see here in this chart a progressive tax. A progressive tax is one in which upper income families pay, well, a larger share of their income in tax than those with lower incomes. And many people feel like, well, shoot, that seems fair, right? Because look down to the next slot there. What's a regressive tax? Well, a regressive tax is a tax that requires the poor and the middle income to pay a larger share of their incomes in taxes than the rich have to pay. Well, that doesn't seem right at all. Why should poorer earners need to pay more, a larger share of their income, right? And then finally, there's the proportional tax. A proportional tax, at least in theory, takes the same percentage of income from everyone, regardless of how much they or little they earn. And we don't really see that much here in the United States. So we're really talking in this lecture about progressive versus regressive taxes. Let's take a look at that. So a progressive tax, again, a progressive tax means that higher income earners are taxed at a higher rate. This will hurt higher income earners more than lower income earners. And the idea here is that, well, that's true, but the higher income earner has more money to pay than low income earners. An example of a progressive tax, well, quite frankly, is our federal income tax system. Our federal income tax system is designed as a progressive tax system, so that as you earn more money, you move into a higher tax bracket and a higher percentage of your income is then taxed. We'll get to that in greater detail as we keep going through this deck. On the other hand, a regressive tax means that lower income earners pay a larger share or percentage of their income in taxes, and this hurts lower income earners a lot more than higher income earners. And some examples of these, well, sales tax, property tax, user fees, what we sometimes call sin taxes. These are all examples of regressive taxes. Wait a minute, how can that be? Well, think about this for a moment. Let's say that two different households decide to buy the same car. The same car that costs in both instances a sum total of $40,000. And let's say they buy it in the same county, and therefore they're paying exactly the same percentage and therefore exactly the same amount of sales tax. So let's say that it's a 6% tax rate on $40,000, right? So you're paying $2,400 in taxes. Same car, same sales price, same county, $2,400 in taxes. Well, you can see where we're going with this, right? If one household is buying that car and they earn $50,000 a year, they're still paying $2,400 in taxes, even like household B. Even if household B is earning $250,000 a year, they're still paying that same $2,400 in sales tax. You get my point, right? That amount of tax hurts lower income earners more. The same is true with property taxes, which are not based upon income. It's based upon an assessed value of the property. The same is true of user fees. What are user fees? User fees are, for instance, the fee that you pay to get into a museum or a park. You get my point? To use publicly accessible facilities or parks and those kinds of things, right? And then finally, this fourth category, what's a sin tax? Well, a sin tax is the tax paid to consume items that somehow, we may have deemed in the past as sinful activities, like alcohol, tobacco, gambling, or those kinds of things that may have, at least in some time in the past, had some moral implication for some folks. Nevertheless, we sort of call them sin taxes. But you can see there, anytime that you're paying a flat amount that's based on something other than income, that flat amount of tax is going to hurt lower income earners more than higher income earners, because that set amount represents a larger share of their potential income. So many taxes can be described as regressive taxes. So knowing that our federal income tax system is set up as a progressive tax to, at least ostensibly, tax higher income more, let's sort of examine, how does this actually work in real life? What's the practical implications of marginal tax rates? Well, the marginal tax rate is the top rate you pay on the very last dollar you earn. But parts of your income that are earned under that last dollar are taxed at lower marginal rates. And so the idea is, when you add up all the different slices of your taxes, which are calculated on different slices of your income, well, your total tax can be calculated as an effective tax rate, which is almost always lower than your highest marginal tax rate. Now, I realize you look at the slide, you may look at the slide 3 or 4 times and it still doesn't quite make sense. So let's give you an actual illustration, and I think will help to make it more clear. So here is an illustration of 2021's different tax brackets based upon filing as a single person. If you're a single person filing for the tax year 2021, then you can see the different brackets of income and the amount of tax you'll be charged on that. So take a look at this slowly. For every dollar you earn between $0 and $9,950, those dollars will incur, or you'll have to pay, 10% tax on that amount. Now, if you've earned over that, every dollar over $99.50 up to $40,525, well, that'll be taxed at a slightly higher rate, at 12%. Okay? Now, for every dollar you earned over $40,525, up to $86,375, that's going to be taxed at 22%. Kind of see where this is going? And finally, all the way up to, if you are fortunate enough to be earning well over $523,000, then the last dollars over $523,600 will be taxed at 37%, which is the highest tax bracket, at least for the tax year 2021. So you can sort of see, if you have earned, let's say, $100,000 for 2021, you can see then your income is actually broken up into 4 different tax brackets. Part of your income is taxed at 10%, another part is taxed at 12%, another portion is taxed at 22%, and then some of your income, roughly $14,000 of your income, is going to be taxed at 24%. So, when you actually work this out, next slide, let's say that you are filing in the tax year 2021, you're single, you've earned a total of $75,000 of taxable income. The amount you'll owe in taxes is actually $12,249, and you can verify this by running that amount, $75,000, through the different tax brackets on the previous slide. Now, if you look at that, $12,249 of taxes owed on $75,000 of taxable income, that's actually an effective tax rate of 16.33, right? In other words, $12,250 is a little over 16% of your taxable income, even though the last few dollars of your income was taxed at a marginal tax bracket of 22%. Now, I understand that this may be a little confusing, and so I've given you a couple of supplementary videos on how tax brackets work, as well as a link to an interactive web page that helps to walk you through the different tax brackets and how this actually works, just so that you understand that you may look at the tax schedule some particular year, or your tax professional might tell you, hey, you're in the 22% tax bracket, but just realize you're not actually taking 22% of your income and just sending it off to the federal government. No, it's probably effectively significantly less than that, and that may still hurt. I'm not saying it won't hurt, but it's not going to be equivalent to just saying, just take 22% of all your taxable income. That's not how the tax system works, but it is built, as you can see, as a progressive system to tax higher income earners more than lower income earners. So I hope this helps. I do invite you to go through and really sort of work through the supplementary materials I've given you to get a good understanding how taxes are actually calculated once you have a taxable income number, and then you work through the different marginal tax rates and brackets to calculate what the total tax owed is. All right, so I hope this is all helpful. I realize we're going pretty fast through this stuff, right? But I've given you some supplementary material to really sort of work through the arithmetic. All righty, hope that's helpful. We'll see you in the next video.